Look closely at this traditional ear-piercing gun. Between 1978 and 2025, Claire's accessories use tools exactly like this to pierce over 100 million ears. That physical service formed the foundation of one of the most reliable competitive moats in the entire retail sector. You cannot downmode an ear piercing. To get one, a teenager had to physically visit a retail location. For decades, this requirement guaranteed a massive, predictable flow of foot traffic into physical shopping malls. Once inside the brightly lit stores, that footfall predictably converted into highly lucrative impulse purchases of high-margin accessories. The stability of that cash flow attracted private equity. In 2007, just before the global financial crisis, the private equity firm Apollo Global Management took Claire's private in a $3.1 billion leveraged buyout. This chart illustrates the immediate structural damage of that transaction. To fund the purchase, Apollo engineered a capital structure that immediately loaded the previously stable retailer with roughly $2.5 billion in acquisition-related debt. Carrying that amount of leverage requires massive, mandatory interest payments. Instead of reinvesting its operating income into necessary store modernizations, upgraded point-of-sale systems, or an emerging digital commerce infrastructure, Claire's was forced to route its cash directly to its lenders. Claire's did not initially stumble because consumer demographics changed or because teenagers stopped buying jewelry. The enterprise was destabilized by a capital structure that left it entirely starved of the cash required to adapt to the impending e-commerce revolution. After struggling under the weight of the Apollo buyout for over a decade and failing to raise public capital via an IPO in 2013, the debt burden finally broke the company. Claire's filed for Chapter 11 bankruptcy protection in March 2018. At the time, financial markets celebrated the 2018 bankruptcy as a highly successful balance sheet stabilization. As shown in this diagram, the company successfully shed approximately $1.9 billion in legacy debt. In exchange, ownership of the enterprise was transferred to its former creditors, led by distressed debt specialists Elliott Management and Monarch Alternative Capital. The flaw in this restructuring was its extremely narrow scope. The new private equity owners executed a liability management exercise. They did not attempt to modernize the underlying business model. This photograph reveals the reality they ignored. The company's massive fleet of physical stores remained anchored in dying, secularly declining enclosed malls, while their core tween demographic was rapidly migrating toward entirely new modes of digital consumption. This deep operational decay was temporarily masked between 2021 and 2022. Following prolonged pandemic lockdowns, consumers engaged in aggressive revenge spending. This temporary macroeconomic anomaly generated a sudden, deceptive surge in physical retail foot traffic. Buoyed on that temporary sales rebound, the private equity owners immediately sought a lucrative financial exit. In September 2021, Claire's filed a formal S-1 registration statement with the Securities and Exchange Commission, attempting to take the company public again. The market conditions violently shifted in 2022, forcing Claire's to abandon the IPO. Trapped in a depreciating retail asset, the owners shifted their strategy strictly to cash preservation. This sequence of events illustrates the core anatomy of a Chapter 22 bankruptcy. A company files for bankruptcy a second time because its initial restructuring solved the balance sheet, but entirely ignored the failing operations. Between 2018 and 2024, Claire's historical defenses were systematically dismantled in a two-front competitive war. The brand found its market share actively eroded from both the premium experiential sector and the discount digital sector. On the top end, the lucrative ear-piercing segment was disrupted by specialized retail startups like Rowan and Studs. These companies captured critical market share by appealing to safety-conscious parents and aesthetic-driven teenagers. Claire's relied on a highly public mall kiosk aesthetic. The newer entrants offered elevated, sterilized, nurse-administered piercing boutiques. The modern approach rendered Claire's traditional model experientially obsolete. On the bottom end, the core accessories and fashion jewelry product lines faced existential threats from extreme fast fashion e-commerce giants. Digital platforms like Shein and Temu offered massive assortments of hyper-trendy jewelry at price points that undercut Claire's value-oriented pricing. These digital competitors utilized highly optimized, direct-from-China supply chains to completely bypass traditional retail distribution models, moving products at an unbelievable speed. This logistical architecture allowed them to react to microtrends on TikTok and Instagram with a velocity that a legacy physical retailer could not match. Claire's was violently squeezed in the strategic middle. The company was out-innovated on the experiential front by premium piercing boutiques and completely undercut on pure price by digital fast fashion titans. To survive this competitive squeeze, Claire's desperately needed operational efficiency. Instead, they suffered a catastrophic internal software disaster. In an attempt to modernize, the company implemented a highly complex supply chain forecasting system powered by the technology vendor Blue Yonder. The implementation failed. The automated system produced profound forecasting errors, directing the purchasing department to overorder highly undesirable, stale merchandise, while simultaneously underordering the high-demand trending items teenagers actually wanted. This image represents the physical consequence of that software failure. In the fast fashion accessory sector, seasonal turnover is paramount. Claire's found itself stuck with a massive glut of immovable inventory sitting dormant in global distribution centers and store backrooms. Look at these promotional signs. To clear out the physical space and attempt to extract any working capital from the stranded inventory, Claire's was forced to engage in heavy, margin-destroying discounting across its entire store fleet. At the exact moment their operational margins compressed, external macroeconomic factors applied a crushing vice grip. The U.S. Federal Reserve initiated an aggressive rate hiking cycle to combat inflation. This monetary tightening weakened the discretionary spending power of their core demographic and permanently closed the IPO exit window. Furthermore, Claire's heavy reliance on cheap Asian manufacturing left it exposed to escalating geopolitical trade friction. New international import tariffs resulted in a projected $30 million direct hit to the company's annual cost of goods sold. Cost of goods sold, or COGS, is the direct expense a business incurs to produce or acquire its merchandise. In a low-margin retail business, absorbing a sudden $30 million penalty immediately and violently accelerates the cash burn rate. By early 2025, the company was suffocating. The combined weight of collapsing profit margins, dead inventory gluts, and approximately $250 million in fixed annual occupancy costs for its sprawling mall real estate triggered a terminal cash flow crisis. With corporate cash management devolving into a daily triage operation and vendors demanding payment, Claire's formally filed for Chapter 11 bankruptcy on August 6, 2025. The detailed first-day declarations revealed the company entered the courts with exactly $690.8 million in total secured funded debt. Looming ominously over this liquidity crisis was a massive maturity wall. As this timeline shows, Claire's possessed $500 million in senior term loan debt, firmly scheduled to mature in December 2026. With prevailing interest rates high and the company's earnings deteriorating rapidly, refinancing this credit facility on the open market was mathematically impossible. Knowing a filing was unavoidable, Claire's engaged restructuring bankers at Houlihan Lokey to execute a pre-petition marketing process. They successfully negotiated a Section 363 asset sale to Ames Watson, a private equity firm specializing in distressed retail. A Section 363 sale is a legal mechanism in the U.S. Bankruptcy Code that allows a company to sell its ongoing business assets free and clear of all legacy liens. Ames Watson agreed to acquire the vast majority of Claire's North America operations and intellectual property for exactly $140 million. The financial architecture, detailed here, was strategically negotiated to minimize immediate cash outlay. It comprised a $104 million upfront cash payment and a $36 million seller note extended back to the bankrupt estate. To make the acquisition viable, Ames Watson utilized the bankruptcy courts to execute a brutal rationalization of the company's bloated real estate footprint. They rapidly filed court notices to officially reject the commercial leases of 291 underperforming locations across the United States. The structural cuts also included the strategic amputation of complex, low-margin ancillary operations. The new owners permanently terminated all 208 of the retail concession shop-in-shops located within Walmart stores, and completely abandoned the older demographic icing brand, closing every single dedicated location. The Ames Watson acquisition followed a textbook distressed M&A playbook. By leveraging the legal tools of the Bankruptcy Code, They engaged in ruthless addition by subtraction, severing toxic liabilities to extract and retain only the most historically defensible, profitable core of the brand. With the physical operating assets safely transferred, the remainder of the Chapter 11 proceedings transitioned into a highly contentious administrative wind-down. In October 2025, the U.S. Bankruptcy Court confirmed a liquidating plan designed strictly to allocate the $140 million in sale proceeds. U.S. corporate bankruptcy operates on the absolute priority rule, which dictates the strict order in which creditors are paid. With $690.8 million in secured debt holding the senior position and only $140 million in total sale proceeds available, the math was brutal. The former private equity owners, Elliott Management and Monarch Alternative Capital, saw their equity interests completely wiped out, receiving exactly zero recovery. The financial realities for the trade suppliers who actually built the jewelry were even harsher. This chart compares the friction costs of the bankruptcy against the creditor payouts. The legal and financial advisors who engineered the restructuring successfully extracted over $23 million in highly prioritized administrative fees. In stark contrast, unsecured trade vendors fought over a legally ring-fenced reserve pool of exactly $1 million. With $78 million in valid claims, that reserve meant suppliers recovered only a microscopic fraction of a penny for every dollar owed. The spectacular demise in a carve-up of Claire's is a highly visible symptom of a broader macroeconomic pathology. Claire's joins an expanding cohort of legacy mall brands, including Joann and Party City, that have succumbed to the devastating Chapter 22 phenomenon, filing for legal insolvency twice within a span of just a few years. In 2025 alone, empirical data shows that private equity firms played a direct ownership role in over 71% of the largest consumer discretionary bankruptcies in the United States. The $1 billion collapse of Claire's serves as a definitive warning. Decades of cultural relevance and historical competitive moats offer zero protection in a landscape where leveraged buyouts and liability management routinely leave companies heavily indebted, starved of capital expenditure, and entirely too brittle to survive operational shocks.